All right, let's get into our last segment here. That's all I got from a news perspective. Anybody got anything else on stocks? You go ahead and shut it out there right now. Nope. Let's go into last segment. Buy one, hold one, and dump one here. Every Thursday, we invite Coach Greg Old Money Holmes onto the show. He is the, writer of the Rookie blog. He's a coach over at Tackle Trading. He's a veteran trader. Used to be a financial advisor. People don't remember that. If you've ever listened to his interviews on the podcast, you'd know that. Friend of the show, friend of our community, and a big, big believer in fundamental analysis. Greg, that's why you got the moniker Old Money Holmes as well. You focus on dividends and growth or fundamental growth and all those type of things. What have you got for us today in buy one, hold one, and dump one?
Well, I got a bit of a weekly routine. I usually kind of look for sectors that are doing well. And the one I found today was Staples XLP. Looks like it's getting ready for a breakout. So I thought that was nice and strong coming into there. So I started looking in the sector. And since we have the Labor Day weekend, the 3-day weekend coming up, I thought what better way to celebrate that than by looking at 3 beer companies. So today we're going to look at TAP, which is Molson Coors. We're going to look at Bud, and we're also going to look at Constellation Brands, which is, as you and I talked pre-production, it's Modelo and Corona, things like that. So we're just going to compare these 3. They got some interesting numbers, interesting things to look over here. Obviously, 2 of them are somewhat in the same price neighborhood. TAP and Bud are not that far away from a price perspective. Constellation Brands is quite a bit more expensive from just a price point. But like I said, kind of in the same business. So numbers wise, I'll just run through them. I think you got TAP up there now. Do you? You should do. Perfect. So TAP, from a chart perspective, obviously in a pullback here, we're looking for some kind of reversal pattern here. We don't have it yet. Trying to hold support, kind of taking it on the chin from a recent high there. So, maybe technically speaking, it might not be the right time for Coors, but it is something that could go on the radar for sure. As a matter of fact, Molson Coors looking pretty ugly, but it actually looks even better from that weekly perspective there, from a turnaround perspective. So anywho, numbers wise, they run down like this. 2.8% dividend yield, so almost 3% there. 0 years of consecutive dividend increases. Started dividends in 1970. Payout ratio is a paltry 18%. Which is good, means they can sustain that dividend. Their PE ratios are a little bit on the high side here at 34. They got sales growth 6.2% this year and 2.6 expected next year. Assets and liabilities, they're all pretty much in line here. You'll see that Bud's got much more, but they're 27 and 14, which what you're looking for there is just the spread, right? You want the spread. You want to know at the end of the day, if they had to close up shop, would they still be okay? And from that perspective, that if you've got a decent spread there, we got a spread of 13 billion there. That's good enough for me. Free cash flow, they're 943 million. So not quite $1 billion, but still that's a fair bit of capital there for a company of that size. 0 years of net income increases. Their net income seems to be a little bit up and down, and that's maybe just part of the business. They do have weekly options, which is good, something we look for. Their covered call, approximately 30 days at the money, is around 2.2%. So not a bad little deal there. Institutions own over 91% of this, and it's been negative 0.62 ownership change, institutional ownership change in recent vintage. So just some numbers that I think are important there. The dividend yield's nice and high. The covered call is you can start to take a little bit of capital out of that as well. So perhaps one of the better cash flowing stocks here. But again, you got to look at the chart as well. You always got to take into consideration the technicals. So Bud's next up on the docket. So Bud, very similar. Now the problem with Bud is it's a foreign-owned company in ADR, so you get to see this kind of gappy stuff here with it. It just is what it is. It's kind of more all over the board, I think, than the other ones. But again, kind of getting beat down here. We're looking for a reversal pattern. If we kind of connect the dots from the high down to where we are now, you want to make sure that if you're doing a trade on this, you need to make sure that this breaks downtrend, and it's working towards that, but it's not done it yet as far as I'm concerned. So might not be ready for prime time, but something to put on that watch list. So numbers wise, these guys, now I will throw out a caveat here. I have a payout ratio for these guys. I looked high and low. I think because maybe they're an ADR that my numbers aren't correct. So I will preface that now. Anyway, dividend yield about 1.88%, 0 years of consecutive dividend increases. They started paying dividends in 1932. So we got a pretty long history of it. Now the payout ratio, the only number I could find was 574%. I don't know that that's accurate. I looked in about 4 different places to find an actual payout ratio for these guys. I was unsuccessful in finding that. So again, could be because it's a foreign owned company. Their PE ratio is 22, which is considerably less than TAP. Sales 14% this year, 5.5% next year. They had a huge gap here in assets versus liabilities, 226 billion versus 148. So a very, very large, asset base versus the liabilities that they hold. Their free cash flow was 9.3 billion, so very healthy. 1 year of consecutive dividend net income increases. Sorry. Also weekly options. Their ROI was very close at 2.1 for approximately 30 days at the money. Now, the thing that I found very interesting was institutional ownership was only 4.5%. So very interesting in comparison to the other two, as you'll see. Institutional ownership change, 1.87% increase in recent vintage. So the next up on the docket is Constellation Brands. Again, this is going to be the most expensive one. It's also the best chart as far as I'm concerned. Again, it's still working for a reversal as well, but it seems seems healthier from a technical perspective, I think, more so than the other ones. So again, higher dollar stock, but their numbers they've got some decent numbers here. So 1.5% dividend yield, 5 years of consecutive dividend increases. They only started paying dividends in 2015. Their payout ratio is 47%, so not bad there. PE ratio came in exactly the same as TAP at 34. Now, their current sales growth, negative 50% for this year, positive 7.1%. That 50%, I think I might have a number wrong there. I might have been 5%. So I think that's negative 5% for this year and positive 7.1 for next year. Their numbers looked almost exactly like TAP, 27 and 13. So very, very close from assets liabilities. Again, the spread there is decent. It's almost 14 billion. So that's good enough. Sitting on about 2 billion in free cash flow, 1 year of net income increases, weekly options as well. And again, cover call 1.9% for approximately 30 days there for Constellation. Institutional ownership was over 80%. And in the last little while, they've lost 1.85% of institutional ownership, meaning they've sold off some. So if you see a big change in institutional ownership, then it's something to look into. These small numbers here are not a big deal. That could just be some profit sharing taking from some of the institutions as well. So, but if you start to see a mass exodus of these, that's something that can concern you fundamentally as well. So that's our 3: buy one, dump one, hold one, gentlemen.
All right, this one's going to be an interesting one for me. I'm looking at all 3. Appreciate you breaking down the numbers and showing us the 3 different companies. And now the game is all 3 coaches here, Tyler, Matt, and myself. We have to decide which one we are going to buy, which one we're going to hold, and which one we are going to dump. Let's bring Tyler in first. And Tyler, you usually kind of reinterpret the data, kind of explain it to us. What do we got here with these 3 companies? What stands out?
Oh my gosh, this one is not easy.
It's not. This is not an easy one. No.
Okay, so here's your lineup of all the data that Greg just gave. This is good because it gives you a side-by-side comparison. I think this is going to come down to what do you value most. Price perspective, I'll highlight just the highlight for each column here. Cheapest is TAP. Constellation Brands, as he said, was quite expensive. Dividend yield, highest is TAP. Lowest is Constellation. Dividend increases. These guys cut it last year in the pandemic. Constellation Brands apparently it did not. Bud's your oldest company. Constellation Brands, the newest company. Well, is that true? I mean, I would assume so since they've been paying the dividends the longest. That's a fair takeaway, right, Greg?
I'm sure Constellation is a newer company.
It's
than,
a new, it's a
Budweiser.
newer,
It's
yeah.
Bud, Tap, Constellation.
Yeah. All right. So payout ratio, not sure on the Bud, but Tap. See, this is pretty good. They have the highest dividend yield and the lowest payout ratio, which means it's not like they got that higher dividend yield by forking out, 90% of their earnings. So that impresses me. PE ratio, lowest for Bud, Tap, and Constellation are about the same. Sales growth this year, Bud is the best. Jack that. There we go. Bud's the best in terms of this year's sales growth. Kind of all about the same next year. Assets versus liabilities. All look pretty similar to me, right?
Yeah.
Not much to write home about there. Tap's got the best free cash flow. I think that's what we said.
Oh, that's the lowest.
That's
there, too.
million.
It's the
Sorry,
lowest.
Yeah.
it's Bud, 9.3 billion, right?
Yeah.
Everything else is kind of sixes, right? The ROI on covered calls, that to me is sixes. Weekly options available on each. I don't really have any commentary on this because I don't follow this metric. So, anyways, there's your roundup.
All right.
I don't know who you want to go first, Tim.
I can go first, or Matt. Matt, you want to go first? Or want me to go first?
I typically go first, right?
Yeah, you usually do.
On this segment.
I just got to take.
So I'm the one that has to go first. Okay.
You don't have to.
I'll go first. Very similar metrics in some of this makes it difficult. There's no doubt about that. I do like TAP's dividend yield, but you got enough free cash flow. Why don't you go ahead and increase that? So I'm going to go ahead and hold TAP, sell Bud. Outside, I see metrics fairly similar in most of Bud and TAP. Constellation's a buy for me. I like the story of this company right now. If you're looking at adding something, Bud, TAP, both bulldogs in this space. There's no doubt about that. Constellation Brands was a growth component of this industry and sector for many years, and that's why people bought it, is for the growth potential. Over the last few years, they've tried to change that. They've tried to change that a little bit, offering dividends, doing stuff that investors appreciate. And Constellation was in that weird moment of growth and cash flow there for a couple of years. Was actually a Tackle 25 component there. So I like the story there. So I got a hold on TAP, dump Bud, pay out more dividend Bud, and then got to buy on Constellation based on these three. That's how I'd rank them.
Yeah, actually, I'm exactly in line with Matt. I think we have the exact same thoughts on it. Constellation is the growth company here. If you go back to the spreadsheet data, there's a couple of numbers that I just want to highlight here.
And they're just starting their cash flow side of it.
Correct. Number one, that sales contraction, that -5%, I discount that completely. That means nothing to me at all. As a matter of fact, the sales numbers are the reason why Constellation is the most exciting. If you look at their yearly actual sales, they've been increasing year over year for about 7 years. Bud and TAP have been losing annual revenue year over year. In fact, Budweiser did 56 billion in 2017. They only did 52 billion in 2019. It's been going down. It's not on the wrong side of that trend. They're a much bigger company. Constellation's got growth components to it. If you go to the chart as well, there's a couple things about it. Number one, STZ, yes, all beer companies have come down. If you looked at all three of them, bang, 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 you're going to see downtrends over the last several months. Constellation still above long-term channels, still above the weekly 200. It's at a major support zone, $212. It's a buy. whether you buy equity or if you want to play leaps, by the way, it's on the poor boy covered call list at Tackle Trading on our list for a reason. It's a fundamentally sound company, has growth components, got good options, but is just the dump here. And I know there's some reversal characteristics on the daily chart, kind of trying to find some bottoming patterns and some support. Just the gappy nature of this company being an ADR now. They're now no longer just a US company, guys. They actually listed over there in Europe. And I don't like the fundamentals behind it. They got to pay a better dividend yield. They've got to get better cash flow. If I have to hold one of those two, it's TAP. I get rid of Bud and I buy Constellations. Yep, I'm with Matt.
Now, how the heck am I supposed to argue against that? Look, if you care at all about the charts, why? There's no way you can pick Bud and TAP over STZ, right? Yep. Even if you didn't know the fundamental story that you guys just laid out, the market is revealing that to you, right? The price action of STZ, Bud looks like an inverse ETF of STZ. So does TAP. So it's like, look, if you cared all about price action and your rewarding strength, you have to go with Constellation Brands. There's no choice. So I concur. I don't know why. I mean, this chart looks great to me. So I would buy STZ. And then to your point, how do you decide which one to dump? From a charting perspective, there's not much different. They're both duds. Bud's a tough one to trade. To Tim's point, the gaps make it challenging. So if I had to use one of the two, yeah, I would use TAP as well. I'm actually interested to see if Greg can argue to the contrary here, because I don't see much that we can. I can't
Greg.
deviate from what you guys just said.
So we've got a consensus, Greg. Are you? Did we get what you think is right, or do we?
I heard Tyler. Yeah, go ahead, Greg.
You guys missed the bar on everything. Like, I mean, the whole thing. Here you guys talking fundamental smundamentals, technical schmecknicals. Who cares? It's all about taste. Coors sucks. Bud sucks. I'll take a Modelo or a Corona any day of the week. Like, it's just easy. It's easy. No, I'm kidding, of course. But no, you guys actually got the way I did, but just for some of the similar reasons, but just a few different ones as well. Budweiser, yeah, I love the fact that Matt pointed out, yeah, where's your dividend yield? Come on. You know what I mean? Like like I said, this payout ratio, I think that number is just messed up because they're an ADR. You got $9 billion that you're sitting on. Come on, reward your shareholders. Let's get this here. The other part that I don't like about Bud that Tyler kind of dismissed there is institutional ownership. That is a big deal to me, right? Institutions are usually owning these things because they're fundamentally strong. Now, I'm not putting all my faith in a metric like that, but it is something that kind of backs up what I believe. And the fact that it's only owned by 4.5% of the institutions, that kind of bothers me a little bit. So that's one thing that makes me want to sell. But TAP, okay, whether I like the company or not, from a technical perspective, I do think that they're kind of starting to make a little bit of a turn there. It's not great, mind you, but on the weekly, they are starting to make a turn a little bit. So you can look at it and say, okay, maybe I'm getting this at a decent price. Even if you're not getting it at a great price, when you start to look at their numbers, I'll take a 3% dividend yield where I can turn around and get, even if I go to a lower delta where I go and get 1.5%, every 30 days on a covered call, that's right in my wheelhouse, right? That's 12 to 15% a year. I'm completely fine with that. So that makes me want to buy TAP for that reason. So Bud's the dump, TAP's the hold. And the buy is obviously Constellation. Like I said, number one for taste. They have better beer as far as I'm concerned. They have a better chart technically, and their fundamentals are good. The only caveat I would ever have is that their stock price is very high. So if you're investing in this, it's going to be a bit of a commitment from a capital standpoint.
I think I heard, Greg. Oh, go ahead, Greg.
I like the 5 years of consecutive dividend increases. They didn't dump their dividend when things got bad, which was okay. And you know what? You're still getting around 2% on a covered call. You're still getting a 1.5% dividend. You can still make that work as a cash flow play, and you still have a growth component to it as well. So